So this is a quick message to all the real estate agents out there on a vitally important topic about the primary mortgage market. Now, this is important always, but especially today when inflation's so high, rates are high, affordability is at all-time low. The consumer really needs the help of their agent because so many, about 60%, go to their agent when they get a recommendation for a lender. So we're trying to give you more of a fiduciary stance to understand what a lender truly is in this market, or if they're just a logo someone's selling, which is actually the case. So if you are on the buyer side of the transaction, primarily over the listing side, you might be more involved with this. However, listing agents too, have the recommendations to their sellers on if they're moving up and not paying cash and so forth. So the most important thing to understand in the United States is the agencies that control every lender, whether it's a bank, credit union, non-bank, credit union, broker, banker, none of it matters. All these logos made up are a pass-through to the agencies that buy, back, or insure these loans. Now you can see behind me very clearly, every conventional conforming loan in the country is bought by Fannie Mae and Freddie Mac under FHFA. If it's a government loan, under Ginnie Mae, FHA, USDA, VA, that's backed or insured by the government through Ginnie Mae. And then you have the investor loans, which are jumbo specialty financing or non-QM. So I don't have to tell you, you know this, the majority of every buyer are going through these types of financing. You're not seeing, outside of cash, any non-traditional financing that's not backed through these agencies. Why is this important? It's important because every bank in the country, keeping in mind they all have to close on time, all have to have good service, all have to have good reputation, that's a prerequisite. Every lender in the country is a made-up logo that's selling to these agencies or are backed by the agencies, and they're not retaining any of those loans. Even though the consumer might make their payment to that company, none of them will retain it. They're using warehouse lines of credit, temporary funding, and then selling it. So direct lender, in-house underwriting, all these nonsense terms you hear, they have no control over anything. That's why we're going to see a lot of mergers and acquisitions because, again, they're having a hard time to compete on a lot of these companies that increase margin and rate sheets trying to sell their logo and not understanding the agency relationships. Once a consumer realizes this, and once you realize this, it's a massive, powerful tool to look past that logo. So now when you're looking at loan originators to potentially refer, number one, you want to have 2 or 3 that you're referring that you are in multiple channels, such as maybe a bank or credit union, maybe a retail correspondent lender, and maybe independent broker. Always make sure you have an independent mortgage broker, which is shopping these lenders against the same agencies. So when you have this in your arsenal, understand that you might like certain humans. You might like this person and this person. That's fine. There's nothing wrong with that. But it's a business transaction for the consumer. There's a product behind the scenes. So liking someone isn't enough. They need to compete and shop for that loan. You can get better offers, less concessions. They can qualify for more. It's vitally important today. So if you look beyond the originator, if you're not sold by the originator, and all you do is do your own independent research on the originator and their company, know if they're an independent broker or if they're an employee of a lender, behind the scenes, these agencies are controlling everyone. So you can disconnect that sales kind of block between you and understanding that. If they're looking for a conventional conforming loan, if it's a Fannie Mae 30-year fixed, why would you want your client paying an eighth, a quarter, 0.5%, 1% higher in rate, or thousands or tens of thousands in fee for the same identical loan that all have to be closed on time and quickly? Well, you would never do that, and you personally wouldn't do that. So if you have this arsenal behind you and you understand it, work to find some really good experienced people in your market and make sure they're diverse and really dig deep to find out, are they an individual independent mortgage broker? Are they a captive retail loan officer or maybe an employee of a bank? It's all fine as long as they're competing, okay? So hopefully that helps. I think it'll help navigate through this climate. We will get through it, but take care. Thank you.